Imagine you're sitting in your home office on a quiet Sunday afternoon when the phone rings. It's not a telemarketer or a friend checking in. It's the U.S. government, and they sound desperate. On the other end of the line, officials from the Federal Reserve and the Treasury are basically telling you that the global financial system is about to go up in flames by Monday morning, unless you step in and stop it. That was the reality for Jamie Dimon in March 2008. The world was watching Bear Stearns, one of the most powerful investment banks on Wall Street, spiral toward a total collapse. Most of us view banks as a place to park a paycheck, or maybe get a car loan, but for the CEO of JPMorgan Chase, banks are more like pieces on a high-stakes chessboard. During that chaotic weekend, Dimon wasn't just looking to be a hero, he was looking for an opportunity. In a deal that shocked the world, JP Morgan agreed to buy Bear Stearns for a staggering $2 per share. To put that in perspective, the stock had been trading at around $170 just a year earlier. It was less of an acquisition and more of a controlled demolition. You watch the news reports from that era and you notice a pattern. Every time the system starts to shake, one name keeps popping up as the ultimate backstop. But here's the thing. You probably haven't considered just how much power that gives a single institution. Why was it always Dimon who got the call? And more importantly, what did he see in these failing giants that everyone else was too terrified to touch? The context of 2008 was absolute mayhem. The housing market was cratering, and subprime had become the scariest word in the English language. Bear Stearns had basically run out of cash. Their counterparties, the people they did business with every day, stopped trusting them. When a bank loses trust, it loses everything. The government feared that if Bear fell, it would trigger a domino effect that would wipe out every other major player on Wall Street. Dimon's phone call led to a marathon of negotiations. He knew the risks were massive. Bear Stearns had a balance sheet full of toxic mortgage-backed securities that were essentially worth zero at the time. But Dimon also knew he had leverage. He secured a $29 billion loan from the Federal Reserve to cover the worst of Bear's trash assets, effectively getting the government to insure his gamble. It was a masterclass in crisis management, but he didn't stop there. Just a few months later, as the crisis reached its peak in September, Washington Mutual became the largest bank failure in American history. While other CEOs were hiding under their desks, Dimon moved in again. JP Morgan scooped up WAMU's banking operations for $1.9 billion. In one single year, JP Morgan had transformed from a powerful bank into a financial titan that owned the remnants of its fallen rivals. There's still a real disagreement on whether these bailouts were a necessary evil to save the economy or a calculated land grab that allowed JP Morgan to grow too large to handle. Some analysts at the time argued that the government essentially hand-delivered a monopoly to Dimon, while others said nobody else had the fortress balance sheet to actually pull it off. One thing was certain. By the time the dust settled on 2008, the map of American finance had been permanently redrawn, with Jamie Dimon holding the pen. After the dust from the 2008 financial crisis settled, Jamie Dimon didn't just go back to business as usual. He started talking about something he called the fortress balance sheet. You hear that term and it sounds like typical corporate jargon. But for Dimon, it was a survival strategy and a weapon all rolled into one. He wanted to make sure that no matter how hard the economy crashed, JPMorgan Chase would be the last one standing. You trace the years following the Great Recession and you notice a massive shift in how the bank operated. While other big banks were licking their wounds and trying to pay back government loans, JP Morgan was bulking up. They invested billions into technology and expanded their reach across the country. They weren't just a bank for Wall Street elites anymore. They became the place where everyday Americans kept their savings and small businesses got their start. This growth wasn't just about being big for the sake of being big. It was about being too stable to ignore. When the government passed new regulations like the Dodd-Frank Act to rein in the banks, Dimon didn't just complain. He adapted. He made sure JP Morgan had so much cash on hand that the regulators would eventually have no choice but to rely on them during the next crisis. It was a long game that most people didn't see coming, but even a fortress can have a crack in the walls. You might remember the London whale incident in 2012. It's a classic story of a trade gone horribly wrong. A single trader in London made a series of massive, complex bets that ended up losing the bank over $6 billion. At any other bank, a loss that size might have triggered a total panic. It was a moment of high drama that threatened to tarnish Dimon's reputation as the smartest guy in the room. Critics jumped on the mistake. They argued that if JP Morgan could lose $6 billion that easily, maybe they weren't as safe as they claimed. Dimon famously called the trade a tempest in a teapot before admitting it was a stupid and self-inflicted wound. The tension was palpable during his congressional hearings, yet the bank's fortress actually held up. They absorbed the multi-billion-dollar hit and still turned a profit that same quarter. This event proved something important to the markets. It showed that JPMorgan was so massive and well-capitalized that even a $6 billion mistake couldn't bring them down. It cemented their status as the ultimate safety net of the American financial world. While other banks were terrified of making a move, JPMorgan was becoming the bank that could afford to fail and still win. Finance people still go back and forth on whether this kind of size is actually good for the country. Some say having one super bank provides a necessary anchor during a storm. Others argue that it creates a different kind of risk entirely. If the safety net itself ever fails, what's left to catch the rest of us? As the years went by, JPMorgan just kept getting larger, waiting for the next time the system would need a savior. Fast forward to the spring of 2023. The banking world feels like it's catching a cold that might turn into pneumonia. You notice the panic starts small, just a few headlines about a bank in California called Silicon Valley Bank. But within days, that spark turns into a full-blown forest fire. People are staring at their phone screens, watching billions of dollars vanish in real time as depositors flee. The fear is contagious. Suddenly, everyone is looking at their own bank and wondering if their money is actually safe. In the middle of this chaos, a new name enters the spotlight: First Republic Bank. Unlike the tech-heavy banks that fell first, First Republic was known for being the bank of the stars. They catered to the ultra-wealthy, offering white-glove service and incredible rates on mortgages for mansions. But as interest rates climbed, those low-interest loans started looking like a massive liability. You watch as the wealthy clients, the very people the bank spent decades courting, start pulling their cash out in a frenzy. We're talking about $100 billion leaving the building in a matter of weeks. This is where the drama really kicks in. The government is desperate to avoid a repeat of 2008. They don't want to use taxpayer money for a bailout if they can help it. They need a private solution, and they need it fast. So who do they call? You guessed it. Jamie Dimon steps back into the arena, but this time he tries something different first. He coordinates a massive $30 billion rescue package. He gets 11 of the biggest banks in the country to chip in and deposit their own money into First Republic to show the world that everything is fine. But here's the thing, it wasn't enough. The confidence was gone. By late April, the bank was on life support. On a Sunday night in May 2023, the regulators officially seized First Republic and held an emergency auction. JPMorgan Chase swept in and won the bidding war. It was a surgical strike. In one move, JPMorgan took over nearly all of First Republic's assets, including about $173 billion in loans and $92 billion in deposits. You look at the terms of the deal and realize it was a massive win for Dimon. JPMorgan didn't just buy a failing bank. They got a loss share agreement with the government. This meant the FDIC would help cover the costs if those old home loans lost value. Dimon told investors that the deal would bring in over $500 million in extra profit every single year. He basically took the best parts of a rival and got the government to help insure the risk. Analysts still argue about whether this deal was a sweetheart arrangement that gave JPMorgan too much of an advantage. Some people pointed out a major irony. There's a federal law that says no bank can buy another if they already hold more than 10% of all insured deposits in the U.S. JPMorgan was already over that limit, but the regulators granted an exception because they were in crisis mode. They decided that breaking the too big rule was better than letting a massive bank just disappear. Once again, the system was saved, but the fortress just got a lot bigger. JPMorgan added 84 new branches in wealthy neighborhoods and a whole new roster of rich clients. While other regional banks were shaking in their boots, Dimon was once again the one holding the keys to the kingdom. It was a clear signal to the market. In a crisis, the big don't just survive, they expand. When you look at a map of the American financial landscape today, you see JPMorgan Chase everywhere. It's not just a bank anymore. It's a gravity well. By 2024, the bank had grown so large that it held more than $3 trillion in assets. To put that in perspective, that is more money than the entire annual economic output of many developed nations. You notice that every time a smaller competitor stumbles, the government's first instinct is to look toward 270 Park Avenue, the site of JPMorgan's massive new headquarters in New York. But this level of dominance is starting to make people nervous. You hear the word monopoly being tossed around in Washington and on trading floors. The drama here isn't about a single crash, but about the slow, steady erosion of competition. When one bank is allowed to bypass the 10% deposit cap because they are the only ones capable of saving a failing rival, it creates a feedback loop. The bigger JP Morgan gets, the more they are seen as the only safe choice during a crisis. This, in turn, makes them even bigger. You watch as small regional banks try to compete. It's a lopsided fight, because JP Morgan is too big to fail. They often get better borrowing rates and have a lower cost of capital. People assume the government will always backstop them, which acts like a hidden subsidy. This creates a real tension in the market. If you're a business owner, do you keep your money in a local bank that might disappear tomorrow, or do you move it to the fortress? Millions of people have chosen the fortress, and that massive influx of cash gives Dimon even more power to dictate the terms of the entire industry. There's a verifiable event that highlights this growing friction. In late 2023 and throughout 2024, regulators began proposing the Basel III Endgame rules. These were meant to force big banks to hold even more capital to prevent future bailouts. Dimon didn't just sit back, he went on the offensive. He argued that these rules would actually hurt the economy by making it harder for banks to lend money to regular people. It was a rare moment where you saw the titan of Wall Street openly sparring with the very people who authorized his acquisitions. Economists still debate whether JP Morgan's size is a stabilizing force or a ticking time bomb. On one hand, having a reliable buyer of last resort prevents total market meltdowns. On the other hand, some analysts argue that we are building a system where no one can challenge the leader. If a single bank controls the plumbing of the entire economy, from credit cards to corporate mergers to government bond trading, the stakes for any mistake they make become existential for the rest of us. You trace the influence further and realize it's not just about the money. It's about the data and the infrastructure. JP Morgan spends over $15 billion a year on technology alone. That's more than the entire valuation of many of the banks they've swallowed up. They are essentially a tech company that happens to move trillions of dollars. This tech advantage makes it nearly impossible for new players to break in. The monopoly isn't just about physical branches, it's about owning the digital rails that the modern world runs on. You zoom out for a second and look at the final picture. It's not just that Jamie Dimon bought a few failing banks, it's that he has essentially built a parallel infrastructure for the entire US economy. When you look at the sheer scale of JP Morgan today, you realize they aren't just playing the game anymore. They own the stadium, the equipment, and they might even be refereeing the match. The endgame here is a concept called concentration risk. It's a fancy way of saying that too many eggs are in one very large, very expensive basket. In 2024 and 2025, you notice that JP Morgan has moved into almost every corner of your financial life. They've expanded into luxury travel, healthcare payments, and even high-end dining through acquisitions like Fig and Renovite. It's a super app strategy, but for a bank. They want to be the place where you book your flight, pay for your dinner, and manage your mortgage, all while they use your data to predict what you'll buy next. But this level of ownership brings a new kind of conflict. As the bank becomes more powerful than some of the regulatory bodies meant to oversee it, the tension reaches a breaking point. You watch as politicians from both sides of the aisle start asking the same question: has JP Morgan become too big for its own good? In recent hearings, some have suggested that the bank is now so large that it's actually stifling innovation. If a small fintech startup develops a great new tool, JP Morgan can either buy them out or simply build a version of it using their $15 billion tech budget. There's a verifiable moment that captured this shift perfectly. In late 2024, JP Morgan officially became the first bank to hold more than $4 trillion in assets. It was a milestone that seemed impossible just a decade ago. It signaled that the emergency era of the 2008 and 2023 rescues had evolved into a permanent state of dominance. Dimon has spent decades arguing that a big bank is a more efficient bank, but the cost of that efficiency is a loss of diversity in the financial ecosystem. Finance people still go back and forth on whether the JP Morgan monopoly is a sign of a healthy, winning economy or a fragile system waiting for a single point of failure. Some say that in a world of global competition with massive Chinese banks, The US needs a champion of this size to remain dominant. Others argue that by letting one man and one bank consolidate so much power, we've created a private central bank that answers to shareholders rather than the public. The takeaway from this story isn't just about one CEO or one bank, it's about how we handle a crisis. Every time the system broke, we turned to the strongest player to fix it. We traded competition for stability. We traded variety for security. And in that trade, Jamie Dimon didn't just save the system, he became the system. You trace the history from Bear Stearns to First Republic, and you see a clear path. It's a story of a fortress that kept growing until it became the entire horizon. I'd love to hear what you think about this. Does having one super bank make you feel safer about your money? Or does the idea of a financial monopoly keep you up at night? Let me know where you're watching from and what the economic vibe is in your neck of the woods right now. Whether you're seeing new branches popping up on every corner or feeling the squeeze of higher rates, your perspective is what keeps these stories grounded. If you enjoyed this deep dive into the world of high-stakes banking, please hit that like button and subscribe to the channel. It really helps us keep the lights on and allows us to bring you more of these stories every week. We've got a lot more coming up on the hidden moves of the world's most powerful players, and I'd love to have you along for the ride. Thanks for hanging out with me today, and I'll catch you in the next one.